Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
It's time to move on to the buyers panel, moderated by Senior Vice President of Corum, William Hill. Here we'll answer questions such as, what's important to buyers that are acquiring in the health tech sector, and how can you build relationships to capture maximum value? William.
Many thanks, Jeff. I'll start with some introductions. Today, I'm William Hill. I'm a senior deal maker based in Chicago. I have a 25-year operating background in B2B software prior to Corum. Here at Corum, I've been leading multiple sales cloud engagements across the health tech sector. I'm joined today with a number of panelists that we'll get some short introduction with shortly here. And let's get going with that. For the panelists to provide a short introduction, specifically we're looking at the sort of key characteristics of companies that you invest in. Also, any deals that you've been involved in that excited you or particularly proud of. Ali, let's start with you.
Sure. Thank you, William. My name is Ali Evans. I'm the CEO of an investment firm called Metamora Growth Partners. We invest in healthcare software businesses that range in size from $2 million of revenue to roughly $15 million of revenue when we get involved. We've completed 5 acquisitions to date. And our most recent one was Healthcare Information Management, which is on my background, which is a automation software for healthcare payers. We closed that in April of 2024 with the help of the Corum Group.
Very good. And Henning, can you share a quick intro too?
Sure. Pleasure to be here today. I'm Henning, the co-founder and head of acquisitions of Everfield. Everfield is an acquirer of B2B mission-critical softwares in Europe, among others. Healthcare, we're running it since 2022 and have done 30 transactions almost so far. I'm coming from a background of 10 years plus investment banking covering the European markets.
Very good. And any particular deals you're excited of or you've recently started?
I'm probably proud of all of the deals we closed so far. With our team in Europe, but this year we closed 2 so far. Quite proud of them. One in France, it's a very modern point of sale solution, and another one which very much closed recently. It's a contact center as a service one, Foxitel in Spain, which we managed to close a few days ago. Proud of these ones. We get them on board.
Very good. Congratulations. And over to you, John. A quick introduction, your background, and any key characteristics of companies you invest in.
Thank you, and nice to meet you all, and thanks for having me. So I'm heading corporate strategy and M&A at Levio. Levio is a business and IT consulting company involved in the digital transformation of organizations. We now employ about 2,000 employees. We're mainly in North America. And we're looking to acquire companies with, say, between 20 and 100 million in revenues, because we're looking to establish our presence in the US in particular. And so looking for value-added service offerings that are compatible in our vertical markets. So companies that would bring interesting clients, logos in these verticals. So this would become our springboard to grow in the US. And maybe in terms of the deals that we're very proud of, I would talk about our latest one, which was a summit partner of Salesforce, and which was owned by four leaders that are all now shareholders of Levio, embracing the Levio challenge. And all of these guys have exercised very strong leadership in the integration of the business, and they all expanded their roles within Levio. Everybody's up for the challenge of the value creation plan that we put together, And so we're bringing this offer to our other enterprise clients, expanding existing client relationships, and making sure we keep employees, clients, and the manufacturing partner, Salesforce, very happy about this. So thank you.
That sounds awesome. Excellent, and congratulations on that one. How about Mick? You're a slightly different buyer there. A little bit of an introduction on your background and the characteristics of companies or a company that you're looking to invest in.
Yeah, absolutely. Thanks, Williams, and thanks to the other panelists and everyone for having us today. I'm Mick Denner, founder and managing partner of Mode Growth Partners. We're a traditional search fund, so I'm a solo entrepreneur backed by equity investors aimed at finding and buying and then operating just one company. So we're looking primarily at healthcare opportunities, both in digital health, traditional healthcare services in the $5 to $50 million range. By way of background, I was a Marine officer for 6 years after undergrad, went off to business school, and then was an operator at Danaher for 5 years in medical device marketing, sales, and then manufacturing. So very excited to be here and very excited to be part of the panel.
Excellent. Welcome, and welcome all of you. We've got a bit of a jam-packed set of questions we're going to go through today, and we'll take them one at a time. And the first one we're going to go to in sort of the order of Corum's optimal outcome process. We call it discovery, and we get to this sort of this question a lot from sellers. Is there a right time to sell? And so I put this question to you guys: is there a right time to buy a company? Henning, perhaps we start with you.
It's a good question, because you can sell your company only once, right? Unless you're a serial entrepreneur. It's to me, it very much depends on the owner and the company. So I think for the owner, it's subjective. It depends on age, change in lifestyle, if you want to start something new, right? But when you look at it on a rational way, and when you really made up your mind, I think that's important. Don't ponder around and think I may. If you make the decision, you go forward. Otherwise, you will not pull through, and then it's rather not successful. But if you make the decision to sell, you probably need to check what's the right time for the company. So is the company ready for a sell, right? That means basically, do I have the company in the proper order? Can I sell facts, and can I show basically what the product delivers for the clients versus selling too much potential? Because investors like us, we struggle when we need to buy too much in future potential, because that's risk basically driving our valuation, and that's where usually like valuation and what the seller and the acquirer expect don't match, right? So for me, it's like right time is when you think your company is ready, when you have all the processes in place, when the software, because we only sell software, right? When you think this is stable, clients are using it, the P&L is performing well, then I think it's a good time. But it's also important to take sufficient time to prepare, because you don't want to struggle with the data. You want to have your numbers ready. You want to know who your perfect client is, so that you can answer all the questions to an investor. Because especially smaller companies, they are owner dependent mostly, right? So you want to make sure that the new owner has the full picture of what you have done. There is a certain handover period, so that there is no risk that the company is going through a rough time when the seller hands it off. That will be my take on it.
Yeah. No, I would agree. And Ali, what's your perspective on that one? Is there a right time to buy a company from your point of view?
Thanks, William, and thanks, Henning. I thought that was well said. The only thing I would add is finding the right buyer is important, who matches with the values that you hold, the things you care about, and who's going to pay you a fair value and close. I think a lot of buyers may market a high value when you first interact with them, but really having confidence that they will do what they say they're going to do, or people of integrity and will close on the transaction that they put forth is important. And so that's the only thing I would add to what Henning shared. I think from a timing perspective, in my experience, because it's the first time many owners have ever gone through this process, they often can underestimate how much work it's going to be and how long it's going to take. And so I would just encourage folks, expect this to be at the fastest a 4-month process, and most likely 6 months to a year, and expect it to be another full-time job on top of your regular job. And so, if you go in with those expectations, then I think you're ready.
Yeah, and we at Corum we call it a journey for the reason. I mean, it's not a transaction in the sort of normal. If you're trying to sell a house or selling a car, it's not a short action by any means. It's more of a journey. Hey, Jean, what's your perspective on it? The right time to buy a company for your perspective?
I agree with everything that's been said, and I would say that the right time is probably the intersection between the right time for the buyer and the right time for the sellers. And so if we think about it in terms of the right time for the buyer, obviously there's the strategic fit that's critical, the revenue synergies that can be achieved by combining the organizations, the operational fit, in the model to keep the people engaged into the new journey. So that operational fit is very key. The scalability potential, because an acquirer buys the future of an organization, so it will want it to be scalable. And obviously the financial and operational readiness of the buyer. So when you have that, as well as from a seller standpoint, I think there's a number of elements there, and the owner mindset, the mindset has to be there, the mental readiness of entering into a transaction that will bring change and will transform the company. So that's got to be there. So to Henning's comment earlier, I think to find a buyer, if it's a strategic partner or a financial partner that's going to help, the company achieve its mission and its vision, because when you sell, it's the beginning of a new journey. Maybe you've deployed all of the resources that you had and you're satisfied with where you brought the company, but you probably have a vision to achieve more with it, but you want to bring someone else to help you do it. So I think that combination, that synergy is important. And obviously, the preparedness from a seller standpoint is very key, because you want to show yourself in a good perspective to potential buyers, and you want that process to be as efficient as possible, because as Ali said, it's very demanding, and it's another job on top of your existing one. It's a very demanding process.
Yeah, we call it the emotional roller coaster people go through with the M&A, and it's my baby's ugly, and we get the LOIs in, and everyone loves me, and we found a problem. I mean, it is a roller coaster, but I think you're right. It's very individual, unique to each buyer. So you have to align all those things you quite said there to find the right fit, and timing is everything in M&A. Nick, what's your perspective on this one?
Yeah, I agree across the board with what everyone has mentioned. I think, again, because I'm the kind of the newer player, the younger face in the entrepreneurship game here. I guess it could be equated to, getting a puppy or having a baby. There's never a perfect time or a convenient time to sell a business or have a baby or, have this radical disruption in your life. But I think as long as there's an element of trust, there's an element of buy-in and a personal connection between the seller and the potential buyer and all the intermediaries involved in the process as well, the accountants, the bankers, the lawyers. As long as there's a strength of alignment there, I think it is a good time to at least move forward with the process and see how it goes. Again, I haven't bought a company yet. I've never sold a company. I understand it's a very emotional process, like you mentioned, William. And so kind of getting over those hurdles, that it will be uncomfortable, it will be a lot of work. and kind of steeling oneself for the grit of the process is a good start. So as long as 80% of those things line up, I think it's a good time to move forward with the process.
Yeah, wisely said, and a great segue to the next set of questions around the process. So, we talk about preparing businesses and founders for the journey ahead. I call it the heavy lift. So what advice would you give to a tech entrepreneur who is looking to prepare themselves for this M&A journey? And actually, as you answer this, if you can provide some past examples where the sellers have gotten it right and where they've gotten it woefully wrong. Perhaps, Henning, we start with you.
Sure, we can, and it blends a little bit into the question before, right? But when you have somebody who is ready to approach the M&A journey, as you say, William, I think it sounds a bit very standard, but we run through a lot of transactions, so almost 30 since 2022 so far, and based on this, basically, I take my experience in that regard. And it comes down to basically have your core company data ready and well prepared 3 years in the past, and also have a business plan which you can elaborate on and which makes sense and is not just hockey stick, right? Because hockey stick is easy, but when you're past the teaser phase and when you're in due diligence, you need to expect that investors will ask some questions about how the hockey stick works. And if you can't elaborate properly on that, you will get into problems, right? Because then they don't believe so much anymore in your potential, and a lot of questions starts. So it comes down to numbers. It comes down to documentation in good order. You should know your clients, not the names, but rather like, what is my ideal client, so that you can lay that out to your investors or the investor that you are talking to when you're exclusive, so that he understands and can do his commercial due diligence properly and can understand what's your market size, how can the product be amended if you want to tap into other client pockets, right? And literally, it sounds very simple, but it's important. Know what type of problem your software solves on a daily basis for the clients, right? Is it mission critical? Is it rather an optional satellite solution? Does it save money for the client? Does it kind of work on and supports like a core workflow for your client? That's all stuff on how investors cross-check the pricing that you have for your products, and whether they can see whether it's appropriately priced and compared to the competition. It sounds very standard, but these are sometimes questions when you're working 20 years on your product and in your world, you will be sometimes surprised by these questions. And I think general, when you speak to investors, they kind of dig through your past. Don't be emotional. They just want to understand how your company works. Don't be secretive about information. If you signed an LOI with a professional buyer, there is not really a reason to hold back. If you are afraid of sharing data about your company, it's probably not the right buyer at all. This is stuff to consider, because if you hold back, if you're too secretive, if you think there's an investor looking at your crown jewels and they might take it away and leave you alone, it's not the investor's setup, right? For example, we as Everfield, we're not there to copy the company and to rebuild it. Our approach is to acquire the company and improve it. I think that needs to be understood, because if you are too secretive about sharing information, the investor can't really properly assess, and it's probably not a trustful start. And that of course goes for both sides, right? The investor also should be very transparent what the plans for post-closing.
Mm-hmm. And do you have any past examples where the sellers have gotten it woefully wrong, like they've come ill prepared?
Yeah, I mean, examples around, like, as I said, not really prepared on how the current year ending is, not having a budget or not having the next year in place, that's making it very tough. if you really don't have a pipeline around current discussions with customers, so that we, from an investor perspective, can assess your probability to close new name sales or to basically create upsell for your existing base because you're developing new modules, then it's getting tough. And if you're not really willing to share who the clients of your product are, it's really tough for an investor to assess a mission critical B2B product. So I think these are the most important ones for us usually.
Yeah. Okay, thank you. And John, what's your perspective on these ones?
Well, I will share a specific example where sellers have gotten it right that we got through recently, and it's about being open and identifying and communicating to us two elements that were potential deal breakers for the sellers, and they were open enough, so they trusted us enough to open up early on it. And so one of the element was valuation driven. So we addressed it pre-LOI and incorporated the results of our work and discussions and negotiations in the LOI. So that provided the reassurance to the sellers. And the other element was dealt with before we fully engaged in due diligence. So right after the LOI, but before we engaged the resources to perform due diligence. So this really contributed to reduce the risk for all parties, as well as build mutual confidence needed to make a successful transaction. So I thought it was a very strong positive. And I think we, as buyers, we have to listen to these elements and really try to build a process that will address those concerns or considerations. And in terms of getting it wrong, if I can share an example, and that's a past experience in another service business that I've been involved with, where we made a number of acquisitions as well. It was in a communication marketing services, so also in services business. And I would say that the sellers would say anything that the buyer wanted to hear. But it wasn't real stuff. It wasn't true. So they would show us unreasonable projections. They would do everything to maximize the cash at close, and we had built an earnout. But right after close, he wasn't believing in the earnout and abandoned it. So Gaia's cash at close, abandoned the earnout. So this was obviously bad for clients. It was really bad for employees. And in the end, it was bad for the buyer. So I think it's very key to have open conversations and realistic expectations and build on the valuation around that, as opposed to just saying anything that the buyer wants just to close a transaction.
Yeah, no, I would agree. Ali, what's your perspective on this one?
I think the only incremental things I would add, things that I've seen sellers do really well, is having, to make it really specific, their articles of incorporation, their shareholder lists, their employee handbook, their insurance documents, like all these things that are very administrative, but having that organized ahead of time, and so you can just give it to the buyer post LOI immediately is good. I think on the financial data and the customer data, we call them customer demographics, but what I find is a lot of entrepreneurs and CFOs of small businesses, they have the customer name and they have the revenues, hopefully broken down by product within their NetSuite or QuickBooks or Sage instance, but they don't have the customer demographics collected. So, how big is the customer in terms of number of employees? What industry is the customer in? What type of customer is it? Especially within healthcare, are you selling to a physician group? Are you selling to a hospital system? Are you selling to a health plan? What line of business is that health plan in? That, if you can already have that kind of data collected and organized in a really easy to understand manner, along with the financial data, that will accelerate the speed that the buyer can assess your business much quicker than if you don't. And so I'd say situations where it's gone well for us, the seller has taken a lot of time to prepare that information. As soon as we sign the LOI, they share it all, are very forthcoming, as Henning mentioned, and don't actually lead with the bad stuff. Tell us the things that are bad early on, customers that are going to leave, employees that are going to leave, or employees that want a raise, things like that up front. And then we can work through the projections together. I'd say times when it has not gone so well is when there's a lot of focus on the projections. Just to be super blunt, I have never used a projection a buyer or seller has given me, ever. We completed 20 transactions. I've never looked at them one time. So having conversations about the projections is basically irrelevant, at least for us as a buyer. What we're trying to do is understand the past and the component parts and what are the leading indicators that I can see and predict based on your past performance that will help me create my own projection. And so, every buyer is different. Some buyers probably care a lot about projections, especially more venture capital type buyers. But folks like us, folks who buy established businesses that have a long operating history, we really want to understand the past really well and have you educate us on what are the leading indicators that really drive future business performance. Example leading indicators can be, number of demos completed in the last month. It could be number of, transactions processed by my software that, if you have a volume-based software pricing component is a future indicator of revenue. Those are the types of things where if you really can understand those component parts of your business, helping educate the buyer on that can really set you apart.
Yeah. Yeah, no, I would agree. And thanks for that. Nick, do you have any additional comment to add? Maybe the examples are less relevant, but any additional items to add when you think about, entrepreneurs preparing themselves for the process?
Yeah, I think it's just good business practice in general, but having your processes documented, your standard work is all documented, helps de-risk that sort of key man, that key operator risk that some buyers might be concerned about. Again, I think that's just good general operational practice, a best practice to have documentation of standards of work in different processes. I've certainly seen it so far done very well, where even a buyer has gone through and done, a very MBA type Peter's 5 Forces evaluation of their own company or SWOT analysis and really, sort of shown how, their baby can be a little bit ugly. I think that's a very humble approach to take. On the flip side, I've worked with some sellers who have no documentation, don't have a basic understanding of a P&L to even walk me through what their numbers are and what, how net income sort of translates into EBITDA or, any other kind of free cash flow proxy metric. But so I would say, coming from a Danaher background that is very process oriented, very lean oriented, just having good documentation, having good standard work to be able to pass on and show, to Ali's point, what are the guts that kind of lead your leading indicators into those lagging indicators and metrics of success. So having those established and documented, I would say is a good best practice.
Yeah. Wonderful. Well, let's move on to our next question. We're going to head into the valuation, which is quite an emotive topic for people. So how would you go about valuing a company? And are there any comments or misconceptions amongst any of the sellers that you've been involved in about valuation? I know I could share hundreds of examples, but what's your perspective on this one? Complex question, but I'd like to get your insights. Perhaps we start with you.
Yeah, functionally, I think, my investor group and I would really value a company on several metrics, of course. Maybe I'll just focus on growth. If there's one metric or one element of a company I would look at before anything else, it's top line growth. There's an investor very prominent in the space who kind of equates business growth to Isaac Newton's laws of motion, that object in motion tends to stay in motion. So companies that are growing with a strong growth profile generally tend to keep growing with a strong growth profile. So certainly that's generally the first thing I would look at. How well are you optimizing your costs down through the P&L? Are you profitable? If not, how quickly will you be profitable? ARR type model. For more traditional service businesses, would value based off of EBITDA and its growth and its profile. But generally, just functionally speaking, from the get-go, we generally value based on revenue growth that try to pick the most important.
Ali, what's your perspective on this one in terms of the how you value a company?
So, I think one to share with sellers, in my experience, most investors use a lot of this set of tools to value companies, but weight them differently. And so, while Mick, you mentioned growth, that may be very important for them. A different investor may really care a lot about profitability and not put as much weight towards growth. Another investor may really care about retention rates. So, how much of your revenue from customers last year occurs this year? Different investors are weighing different metrics differently. I think for us with valuation, one of the things that I think is really important is whenever we talk about valuation, we also talk about structure. The two things are inextricably linked. And so if you want an all-cash deal paid up front, the value will be lower than if you are open to a structured deal where some of the consideration is paid later, some of the consideration is performance-based. I think Jean mentioned a deal that was found in it. That can lead to a much higher overall valuation. So structure and valuation are inextricably linked. And ultimately for us as a buyer, the way we think about it is whatever we pay, whether it be upfront or over time, we want to make 10 times our money on that in 10 years. So we build a financial model, we forecast the model, and we believe in 10 years we should make 10 times our money. And that's how we back into what should the price be today, what should the structure be over the course of the time we pay out value to the seller. We do not share our models. So, the point around transparency, if you ask us for it, we will tell you no. But I think, the way that I always advise sellers is, hey, our model basically assumes the business is going to keep doing what it has done and maybe a little bit worse. So to Mick's point, objects in motion stay in motion. We are going to underwrite the business to do roughly what it's done historically and maybe a little bit worse to give us a margin of error because life can punch you in the face. And so if you built a model and you assume that and you figure out, hey, in 10 years from now, will we make 10 times our money or not? That's going to pretty closely align to the price that we're willing to pay up front. So anyways, that's our personal approach. Different investors have shorter timelines. Sometimes they have a 3-year timeline, 5-year timeline, 7-year timeline. It doesn't mean that we're going to sell our businesses in 10 years. I think like Everfield, we'd love to own our businesses forever. But 10 years is we view enough time that it gives the business time to accrete value to where that 10x return is reasonable.
Mm-hmm. Yeah, that makes sense. Henning, Everfield is a buy and hold type operation. What's your perspective on this one? How do you go about valuing a business?
Happy to chime in. That I think what you laid out, Ali, how to look from the various perspectives is very valid. That we do that as well. I think let me start probably from a misconception and then probably roll back on how we look at things. And I think that probably some of the misconceptions that you see is like we don't look at Bloomberg and take an average, a top line recurring revenue and just apply it to your company. That's not how it works, and that's usually the reason why we ask for a lot of data, why we ask for the full P&L, the types of revenue. We look at the historical growth. For us, more or less, a gating item is profitable growth. So we ignore declining businesses because it feels like something is odd with the offering, right? And unless the specific reasoning is provided, but it's an uphill battle in that regard. And cash burning businesses is like, because we want to hold them for long, right? We look for the profitable growth, but as also like Ali and Mick laid out, we look at a lot of factors: revenue quality, the churn, the gross to net churn, the customer distribution, how long-standing are your customers, how long do you need to kind of get a new customer on board. That comes to planning, right? Because the historical growth and the historical profitability speaks for itself. You can't change that. You can argue around that, But I think having like 5% growth for the last 10 years and then kind of having a hockey stick attached to it, it will be tough to explain. And that probably leads to kind of very different views on valuation, and probably to, speaking in your words, Ali, to a very structured deal if you want to get that valuation. And so we take a lot of time to come up with a valuation, and some sellers, because they're approaching the process for the first time, they sometimes don't understand why we need this granularity of information to come up with a proper valuation. But the reason is that we take all these bits and pieces and we score it or we weight it, and then we come up with a blended valuation for the respective company that then can be expressed in a simple multiple, but there is more math behind coming up with this multiple. And William, the misconceptions is, as said, we don't take the multiple from Bloomberg and adding a variation to it. And for us, and probably Mick, that's different to you, we look at growth 100%, but we also look at profitable growth, because we're building this permanent and holding structure. And it's important for us that the companies are in a stable mode, continuous growth phase.
Mm-hmm. Great. And Jean, what's your anything to add on this topic?
Just a few items, and I do agree that one valuation method is not sufficient. So that would be a misconception. And valuation is an art that's derived from multiple and diverse valuation methods. And so we look at a lot of different things. And again, buyers are interested to understand how the asset will fit into its overall strategy and how it can really propel and grow with this asset. So multiple factors as growth, profitability, size is a consideration, scalability. So the readiness of the organization to scale is obviously a necessary ingredient to support the what we see in terms of a hockey stick pattern in most of the forecasts that we see. So in order to support this, you need to demonstrate that you're set up to scale. Obviously, strategic fit, rarity of the asset is also an element. So if a portion of the industry has already been largely consolidated and there's only a few assets, it may be that some buyers will be ready to pay a premium for these assets. So we maybe just a few views. We obviously build DCFs, discounted cash flow models. It's one way of valuing, and we always perform what we call a standalone valuation. So we're trying to understand what is the intrinsic value of the asset we're acquiring on a standalone basis. And then we will build on top of it based on, we work with the business and develop a value creation plan. So what is it that we can achieve with the asset to understand, a model that will reflect the expected synergies that we see from the transaction. And we'll look at precedent transactions, market multiple, but in the end as well, there's the cost of capital that we use to discount those cash flows. So sellers can sometimes show very optimistic view of the future that sometimes is not even supported by history. But the buyers then will incorporate risk factors in their discounting methods to penalize those future cash flows because they're probably unlikely to occur. So.
Mm-hmm. No, that's great. Now, I would I completely agree with all of those comments. Let's move on to the heavy lift area of due diligence. Corum, we talk about deals go to die in due diligence because a lot of businesses fail, and if you're going to fail, that's where you're going to fail. So let's talk a little bit about the number of percentage of transactions that don't make it through due diligence. How long does the DD process last? and any deal breakers. We covered a little bit of this previously, but if they've uncovered in DD, if there are deal breakers, when do you walk? Perhaps we start with you, Ali.
Sure. So in our experience, deal processes differ a lot. It kind of depends on how much information is shared before a letter of intent and exclusivity is entered. I'd say if not very much information is shared before we enter exclusivity, deals have more variance in terms of do they close or not. Let's say probably a third of those deals close. I think deals where there is more information shared, customer by customer information, long dated historical financial information, process information, meetings with more than just the owner, those deals have a very high likelihood of closing, 50, 60, 80%. In terms of the diligence process, deal breakers, especially for healthcare software, we focus on healthcare software businesses. There are obvious ones, fraud, issues of, cash. We do what's called a cash proof. So making sure everything that's in your financials closely ties with actual bank deposits and actual bank withdrawals. Like if those things don't tie, those are immediate deal killers. Tax can be a big issue. Sometimes sellers will, do things to minimize their tax liability. Some of those things are, seen as okay in the industry. Some are very much not okay. And so tax can be a big issue. Specific to software companies, technical diligence can often be a deal killer. In particular, cybersecurity vulnerability, especially within healthcare, if there is PHI or protected health information that is vulnerable, we will not close a deal because that's Wall Street Journal risk, which we are not in the business of taking on. And then the last thing I'd say is big customer issues, especially if you did not tell us up front. So I think if you told us up front, hey, we think this 10 or 20 or 30% customer, and those percentages are a percentage of revenue, are going to leave, we can factor that into our valuation and then come up with a deal that works for both sides. If you don't tell us, and our expectation is that they're going to be sticking around, and then midway through diligence, we find out they are going to leave, often what happens is then for us, the structure that we originally entered no longer works. And that can be a challenge to work through with the seller because from their perspective, they want to do the deal that they were going to sign up to, even if the customer left. And so I would say that's the other issue that we run into from time to time.
Yeah. And Henning, any things to add there?
It's very very complete already. I think from our point of view, once we're in due diligence, it's very important that you get the deal done because I think it's a lot of opportunity cost involved to kind of break the due diligence after 1 or 2 months for both sides, right? Because from our side, we could have done another deal. We could have spent money on the deal that went through, right? So we're taking a lot of time to gather information and to have honest and transparent conversations until you sign an LOI. And for us, doing a deal exclusive once the LOI is signed is a requirement. So we will not entertain like a deal where the data room is open for 5 parties and everybody's rushing, because when you rush, you tend to miss information, important stuff. When the founder is getting shielded, for example, it's tough for us to really get granularity of the information. So we rather stay out of these processes if there is no opportunity to get exclusivity. Because once you're in exclusivity, we spend sufficient time. And as we said in the beginning, it's like for the founder, there's a second job on top of the daily business, because we look at finance, we look at tax, we look at commercial stuff. All of this is important. And I think when we stumble upon, and usually the investors dig quite deep, right? When you stumble upon stuff that the owner didn't tell you, that is usually tough to digest, especially when you then have like a trust topic, right? Where you find out, hey, customers are leaving, but you promised us they stay for a long time. And even that's your top 10 customer, that could get you into real problems, because then I think you lose trust, or at least we lose trust, and said, hey, what else is there? So we need to dig deeper. And I think then you're already running into trouble somehow. Clear deal breakers is, for example, if the tech compared to what has been told to us is very legacy, has, as you said, Ali, has vulnerabilities. That is tough because we want to grow the company, so there needs to be a scalable tech base. The other thing is, like, if not disclosed, that a lot of third-party IP is involved in your product, and we didn't know before, because Everfield wants to own companies that own the IP, because that's the key requirement. Tax sometimes can be tough, because especially in European countries, taxes are very, like, let's say, not homogeneous. So you really need to understand what kind of tax risks you potentially can entertain and where there is a red line. And usually we try to get that done in 3 to 4 months from LOI signed to SPA signed and closed. That's usually the aspiration on our timeline.
Mm-hmm. Okay, thanks. And Mick, what's your perspective on this? Given that as a searcher, a slightly different focus, I would have thought.
Yeah, slightly different. I mean, I haven't closed on a business yet, so all of the deals I've had under diligence have failed. So 100%, to answer your original question, haven't closed yet, I will say. But in terms of deal breakers, nothing really to add from what Ali and Henning shared. I will say just kind of any breach of trust between me, the buyer, and the seller, really would be an immediate kind of deal killer red flag, where my long-term success and my fund's long-term success with that business heavily relies on the sort of experience and the knowledge that the founder owner has. And if there's any sort of indication that there's sort of less than truthful information sharing or anything to sort of over embellish elements of the business that really couldn't be found out in diligence, as hard as we look, that would be a pretty big deal killer. So having a strong foundation, elemental level of trust is really important. And I think part of your question too was on the deal team. I think most buyers, if not part of their organizations, will outsource accounting help for a quality of earnings report that Ali mentioned, kind of tracking dollar per dollar where things are flowing through the business. Of course, legal teams that are going to draft the purchase agreements and review a lot of the legal background of the business. And then any sort of technical consultants who might be needed for technical diligence, software diligence, things like that. So depending on the deal, depending on the company, the deal team can be pretty substantial, which kind of speaks to the importance of, once a deal is under diligence, it's very costly for both sides of the equation to kill a deal. And, it's very unfortunate that happens. But, that's the sort of the reason for having all that backup is to make sure it's a solid deal, it's got great bones, and can continue moving forward.
Yeah, you make a good point there. Both sides have got cost in a deal through diligence, and usually the buyer is heavy because you've outsourced the third-party providers during that period. I've seen some big figures in the closing statements in that regard. John, anything other to add from your perspective?
There's many very good examples that were given. I would say that normally it should be a very low percentage that fail in due diligence, and the key to have a low percentage to avoid those opportunity costs is really to make sure to disclose all the material information pre-LOI, because if obviously a buyer finds out about the material information that it didn't know about, then it can obviously kill the deal. I would simply add that I put them into 3 buckets, and there's many examples that led to loss of trust. So this is absolutely key. You need to maintain trust between the parties as you go along. So anything that can lead to a loss of trust is one category. Another one is reputation. And that could be the reputation of the target company or the owners of the target company for some reason. So, and there is due diligence that buyers perform on those elements, because when you acquire the company, obviously you acquire the history of the company, of the brand, of the leaders of the company. So that element is very important. And the third bucket I would put is an inherent poison pill. And what I mean by that is, for example, discovering that a delivery office operates in a jurisdiction that the buyer doesn't know, for example, and that the way the business is conducted in that jurisdiction is not according to local laws. And so, how can you really transform this to make it a regular situation going forward while leaving the risk to the sellers at the transaction? But this I would call is potentially an inherent poison pill. And I've seen situations where some buyers simply walk away when they see some of those things. So this is the kind of information that should be disclosed pre-LOI so that there's no bad surprise for anyone.
Yeah. And it's one of the reasons why we call, in the core model, we call it progressive disclosure all the way through. So you're in discovery diligence, pre-LOI, and then you get to confirmatory due diligence, post-LOI. And so it should be quick, and it should be confirmatory by nature. Let's move on to after the deal. So you get in through closing. What does a typical post-acquisition employment agreement look like in your model? Perhaps, Henning, can we start with you? How long do the executives stay on the term? What does the structure look like, etc.?
Happy to start. And how long the executives, or so that the sellers most often in our situation stay on really depends on what is agreed and why they also sell the company. We have more or less all the situations in our portfolio, in our portcos. There is the one founder who basically prepares for a succession and has the plan to stay for another 2 to 3 years, which we're happy to entertain. There is another founder type who says, when I sell my company, I don't want to be the boss anymore because it's just a different setup if you have a shareholder, which is also fair. And I think in this regards, we just want to make sure that this is communicated transparently, because having the situation that you sign the SPA and then you don't sign the employment agreement because you don't want this is not okay. Transparent about it, and we usually then have an open conversation whether within the company there is a capable second in command which we can then coach to become the CEO, and we agree on a certain handover period because of the knowledge transfer of the founder. Or we need to find an external person, basically, or within another person within the Everfield group to run this company. That's all on the table. What is very much important for us is transparent communication about this, because the management board or the CEO has a lot of knowledge and experience in this company and the sector, and you can't replace, and you don't want to replace such a person from one day to the other, especially when you made different plans. It will take a long time, and I think planned succession is the best. And I would say in our case, William, on average, the selling founders, they work with us for 2 to 3 years. That's how the employment agreement is structured. It is open-ended. We can do it longer, but that's the usual timeline which we see. We have a few younger founders on board. It's really open-ended. Let's see what we can achieve together. And usually it's a clear incentive performance component in these contracts, which aligns basically the interest on achieving profitable growth. That's usually how it's structured.
How it works. Yeah. And Ali, anything to add there? Any differences from your perspective?
Largely in line with everything Henning shared, what we ask every owner or person we're buying a business from is, in their heart of hearts, what do they want to happen day one after they sell the company? And we really mean it. We are completely happy regardless of the answer. The bad answer is where they tell us what they, that they want to stay, but that they really don't. Something that is not genuine. So in our experience, like I said, we've closed 5 transactions, in those 5, we've had one seller, left the day that we closed the deal. He wanted to go retire and play golf. And then we had another transaction where, seller's still there 3 years later. And so there's a big range. The median is probably somewhere around the 6 months to a year mark is what I see most folks want to do, transition, make sure their employees are taken care of, customers are taken care of, but then most business owners who've been running their own business for 10 to 20, some 30 years don't love having a board of directors and shareholders and folks who track metrics every month and quarter. And so staying in the seat for longer than 6 months to a year, we find for most people is not what they want to do.
Cool. Yeah. And lastly, Mick, because your model is slightly different being a search, so what's the perspective on sort of the transition period for a founder for you?
Yeah, that's where I think a solo entrepreneur like me would be a creative exit plan for some sellers, in the sense that we are completely flexible and completely creative with how long a seller wants to stick around. I'm working on a deal now where the founder has built an incredible business. He's a medical doctor by background. He doesn't want to be a CEO, doesn't want to run the company and lead people anymore. He wants to focus on clinical things. So, he will likely move over to a chief medical officer type role. So that's a very functional way that he can contribute to the future of the business. And he plans to stick around indefinitely and kind of roll a decent amount of equity and continue growing the business and take a second bite of the apple or third bite of the apple down the road. So, that's where I think the search fund model is very advantageous in its creativity and its flexibility to keep owners involved as much as they want to be, or like Ali said, if they want to go and ride off on their yacht and play golf every day, they can do that as well. So a lot of flexibility, a lot of creativity in the way we can structure our deals and keep the owner as involved as they'd like to be.
Yeah. Well, very good. Well, gentlemen, I've been told that we've run out of time, but it's been excellent having this discussion with you. We're very much appreciative of your participation and especially your insights today. So thank you very much for that. At this point, I'm going to hand back over to Jeff. Over to you, Jeff.